within our group project, we were supposing that complementary firm is the same as a complementary group. Someone that participates to a firm's business by financing it and financing its value. But then somebody of our group started saying that it could be possible that a complementary firm to be so has also to be a competitor. But what I was like, what we are not understanding is if there's an alternative, so different scenarios that can arise, so that complementary firm can also be a competitor and be both a complementary and a competitor, or has to be a competitor while being a complementary.
Okay. This last is the right answer. So I will explain it again. Okay, this is the token code. Okay, so usually a complementary product is a product or service that enhances the value of a specific product, different product. So for example, as we did the example yesterday, sugar may be seen as a complementary product to coffee. Okay. What happens in platform ecosystems, and especially in digital platform ecosystems, is that different complementors, that is different producers of complementary product or services to the platform. So the perspective is the one of the platform, can be competitors on the external market. So for example, if I am the platform and you are complementors, okay, you produce complementary products or service for the platform, okay, that is for my product or service. And in the same time, it may happen that you are also competitors.
It may happen.
It may happen. So it's not a general rule.
Okay.
Okay.
So it's not the main definition of complementary.
No, no. It's just a characteristics of the digital platform, especially. So we can have complementors that are also competitors. Okay.
Okay. Thank you.
Welcome. So yes, it's like Apple and Samsung. So they are complementors from one side. Samsung is a complementor for Apple, and it's also a competitor in the market. But again, it's not a general rule. It is something that is more frequent in digital platforms or in technologically driven industry, in which, of course, we have two levels of the competition. The one that is providing and producing the platform, and so I can have a complementor, and then the final market that is selling the smartphones, for example, and I can have competition, but again, it's not a general rule. So it's clear?
Yeah.
Okay. So okay, so dear professor, I have two questions. One of them is about dynamic capabilities of a company. What are the factors of dynamic capabilities? So, Foro, what do you mean with factors of dynamic capabilities? So when we can define a capability as dynamic, is this the question? And the other one is about Porter's value chain that is just used for the product approach. Do you agree? Yes, I made a premise yesterday in which I specified that most of the frameworks, and especially the ones developed by Michael Porter, were developed especially for the industrial firms that were the most common kinds of firms in the times in which these frameworks were developed, so in the mid-80s of the last century. And so, yes, usually it's used again for the manufacturer or for the industrial firms, because we have operations as one of the main activity. How a company can be defined to have dynamic capabilities. So the dynamic capabilities is a capability that the firm is able to transform, let's say. So a dynamic capabilities is a capability that is able to evolve according to the evolution and the external changes of the external environment. So if I have the capability of innovating, for example, I have a dynamic capability is nowadays, if nowadays I am able to develop, for example, artificial intelligence or machine learning products or services. So dynamic means able to change according to the external environment, okay? Okay, so let's start with this lesson that is chapter 7. So also for this chapter, like for yesterday's chapter, we will see some concepts that already found in some of your previous studies, especially where economics based, let's say. This chapter deals with the methods that companies can use for evaluating innovation projects, and also for the main instruments. And also for the main instruments that again, a company can use for choosing between different investment projects, different innovation projects. So basically, we have two main alternatives when we have to evaluate a project. We have one approach that is mainly or quite totally quantitative, and another one that is mainly or quite totally qualitative. Yes, I can mute her. Okay, perfect. So we have strictly quantitative or mainly quantitative approaches and methods, and strictly qualitative or mainly qualitative methods or approaches. Of course, both of them have positive and negative elements, or pros and cons. The main positive elements of a strictly quantitative approach is that, of course, they are usually based on mathematical and statistical equations. So, of course, they are usually believed to be better, let's say, than the purely qualitative approaches. But of course, in general, the quantitative methods are based on estimates. So of course, if I apply a quantitative method to an estimate that is maybe not correct, the overall value and significance of the quantitative method, of course, will decrease. On the other side, strictly qualitative methods have as their main limit that they are not supported by mathematical or statistical techniques. So we will see which are the main, today we will see which are the main quantitative methods. And of course, we will see some of the main characteristics, again, positive and negative characteristics. But we have to know that usually firms combine both qualitative and quantitative methods. So none of the evaluation is only based on the quantitative methods or on qualitative methods. So let's see which are these quantitative methods. So first of all, an innovation project, like all the other new things that a company does, is usually evaluated as an investment. So the methods for evaluating innovative projects are exactly the same that we use for evaluating investment projects. So they can be referred to the capital budgeting techniques. As we are talking about capital budgeting techniques, we will start from the budget, and especially the development budget. So do you know what is a budget for a company?
Money that they can spend or whatever.
Yes. A set amount of money that usually companies can spend in one activity or in one project. The development budget, and usually this amount, this set amount, is supported by specific documents, okay? The development budget is a budget okay, the development budget is a budget that is developed, that is realized for the development. This means for future investments, especially in innovation projects. So, of course, the development budget starts from one of the most general rules, especially for the financial management of the resources within a company. That is that money is a limited resource. So capital has to be is a constraint, of course, for the activities of a company. And so we have this capital rationing. This means that usually we have a set amount of total money that we can invest in different projects. When we talk about R&D expenses, so expenses related to the development of new product or processes, we use this capital rationing. This means that usually companies fix a specific rate that is dedicated to investments in R&D. And this specific rate is usually related to the amount of the sales of the previous year. What does it mean? It means that in year 2020, our total revenues from the sales were $100 million, okay? Our development budget is dedicating investing the 20% of the previous year total sales in R&D, okay? This means that we will spend and invest the 20% of $100 million in R&D. This is the meaning of using capital rationing and using, of course, a fixed R&D budget, okay? So first of all, we have to dedicate, again, a specific amount of money to investment projects, okay? And usually this specific amount, again, is calculated as a fixed percentage of the previous year's sales from the revenues. Once we set this development budget, so once we decide to assign this rate, okay, we will choose among the projects that are ranked on the basis of the return that they guarantee to the firm. So for example, if I decide to invest yes, okay, I will explain again capital rationing. So we all know that money is a scarce resource, okay, for companies. So of course, we have to manage and allocate money with a rational criterion, okay? How can we decide how much money we will invest in R&D? As again, we are always talking about technological innovation. So we are choosing how technological projects to invest in. Capital rationing means that we set a fixed rate of the revenues to invest each year in R&D. Okay, and this rate is based again on the previous year sales. So it's based on the revenues of the previous years that come from the sales. So usually we have some set rates. This means that according to the division in industries of the whole market, we have that some industries spend or allocate a defined percentage of their previous year sales on R&D expenses. So this fixed rate of expenses is usually based on the benchmarking at the industry level. So for example, pharmaceutical companies usually allocate 20% of their previous year sales in R&D, okay? Or we can have companies within specific sectors that allocate more, that decide to invest more in R&D expenses. And so, of course, in this case, the benchmark is historical. So it's based on the previous rate of expenses that a company allocated to R&D investments. For example, we have a list of the main industries, okay? So this is the code of the industry. We have that, for example, all the companies that belong to drugs, biological products, and diagnostics usually spend 20%. So the intensity means the rate of the previous year's revenues, okay, spent in R&D, and this is the amount. Okay. Okay, so this is usually an estimate that is made each year or each 2 years, okay? So it's quite simple. It's just deciding to allocate an intensity of R&D investments. That means a rate of the previous year's sales in R&D expenses, okay? Just let me check here. Okay, as I said, we have some fixed, or let's say some average percentage that here you can see for each of the industries, of the main industries. So usually we can say that in this, for example, in these industries that is related with drugs, bioproducts, and diagnostic, we have the 20%. But we also have, for example, that the last line, that is motor vehicles and motor vehicle equipment, just allocates the 4% of the revenues of the previous years in R&D. So of course it depends on which industries are more technological intensive or knowledge intensive. So which industries base their development and their success, we can say, mostly on R&D, okay? One thing that we can see by analyzing this table is that the no-store retailers, so this means companies that are retailers but not in physical stores, Amazon, okay, have an average of the 7%, okay, in investing in R&D. But if we change this table with this one, we can see that Amazon has a 12% of investments in R&D. So as I was saying, the rate that is allocated to the R&D expenses can be estimated both at the industry level, so with a benchmark at the industry level, or based on an historical allocation of a company. So we can have that some companies within an industry allocate more, okay? Because of course, in this table, we have an average of the allocation. So as it's an average, we might have companies that invest more and companies that invest less. Okay. So the first tool, let's say, to analyze this, the innovation project is this one. So deciding how much to allocate. Yes, Joanna, I repeat what, sorry? Okay, why in one table is 7% and in the other 12%? Because in this table, so in the previous table here, we have the average R&D intensity. So of course, considering that this is an average, we might have companies that allocate more of their revenues to R&D expenses. And one of these, as an example, is Amazon, that belongs to companies indicated in line, so non-store retailers, but it has a percentage of 12%, okay? So in the previous, we have the average, and in this one, we have the intensity, so the rate of the total revenues according to each company. So we might have companies that invest more in R&D, and maybe we can say that their success might also depend on this. So in investing a lot on R&D. Okay. So first of all, allocating money. So preparing the development budget, deciding to allocate a specific amount of money to R&D expenses. The second step is choosing between alternative projects, okay? So here again, we make reference to two of the most common methods that are used to evaluate investment projects, okay? So we have the methods that are based on the discounted cash flows, that are the discounted cash flow, the net present value, and the internal rate of return. And we have also the real options method. Have you ever met in your life as students these methods? Yes?
But I'm from communication, so instead of R&D department, I saw it for communication budget.
Okay, so for the budget.
Yes.
Okay.
They're the same name probably, but
No, we have a variety of different budgets in a company. We have the master budget, that is the document that just includes all the different budgets. And then we have the production budget, the communication budget. Okay. But for this method, so the net present value, the internal rate of return, the payback period, do you know what they are? What these methods are? Yes? Yes? No? Yes? just to know if yes, if it's yes or not. I don't want you to tell me what they are. Yes, okay. So half and half. Okay, you know internal rate of return, the time value of money. Yeah, perfect. Okay. So let's see what these methods are about. Here again, we are introducing the quantitative methods for evaluating an investment. So we need mathematical, in this case, instruments or formulations for evaluating which project is better than the others. In this case, we can rank projects and decide to which project allocate much money, let's say, okay? So first of all, these methods, again, are related to the evaluation of the investment project. So they are usually studied within the capital budgeting techniques. Yes, investment decisions, yes. No, they are two different methods. So the discounted cash flow or net present value and the internal rate of return are different options, but they can also be used together. So first of all, let's start from the payback period. The payback period is useful for defining what is the period in terms of year. Okay. So what is the time? And usually so it is used to analyze what is the time that the project needs to recover all the initial invested money. Okay. So as the name says, the payback period says what is the length that the project needs to make the company recover the money invested. Okay. So this period, this payback period, is usually defined as the time that it takes for an investment to pay for itself. So usually each investment is composed by one initial sum, one or more initial sum, that is the initial investment that is needed, and a variety of positive inflows or positive cash flows that derive to the company from that investment. So we have one negative cash flow, that is the initial investment, and several positive inflows, positive cash flows that represent the way in which a company should make money from this investment. Okay, so let's see how it works. So I don't know why it's so bad. So we have that the payback period in its formulation is usually like this. So we have at the numerator the investment required for a specific investment again. And we have the annual net cash inflows. So the positive cash flows that a specific investment generates. This is usually the formula that is used when we have the same amount of cash flows for each year. So we say that, for example, an investment needs an initial negative cash flow of $10,000, for example, and will generate as a positive inflows 1,000 euros per year. So the initial investment is the negative cash flow, is the outflow. And at the denominator, we have the annual net inflows. So the positive cash flows that returns to the company from that specific investment.
I was just wondering, this is about innovation, right? So if we invest in innovation, well, if you build like a discount cash flow model, just like a basic Excel one, we estimate, right? Like what we need as a cash flow. And we have like certain years before that, which we rely on.
We have, sorry?
We have like certain years before that, like that we rely on to build like a cash flow model, right? So if you have like an innovation, it's just like made up the payback period. Like we don't know what comes back, right? We don't know the revenue yet.
We can estimate the revenues. Okay, yes. So this is one of the first limits of this quantitative model. And also one of the limits in the financial economics of all the financially based models. So all the models that are based on the estimates of cash flows. So while, for example, if we have to estimate revenues, it is easier for certain ways because we already have an historical basis for the revenues and they are more certain, we can say, as sums. Cash flows are different because they are cash, okay? So they are without some elements that, for example, we consider in costs or revenues. So this is very, very difficult to estimate, but it's an estimation, okay? And again, it's one of the main limits of these methods. But also, for example, for the discounted cash flow model that is useful for estimating the value of a company, that is usually used for estimating the value of the startups that don't have historical data on costs and revenues. So it's hard to define, but it's the only, till today, it's one of the only ways for estimating, again, the value of the projects.
So the payback period is given in years?
Usually it depends on what is the length in which the inflows, okay?
Because I saw annual. So.
Yes, usually the base is the year, okay? So this is an example that maybe makes it easier to understand how the payback works. So in this case, okay, not to reach the break-even. Okay, the break-even point is related to the cost structure of a company. So it's not related to these that are financial dimension, while costs and revenues are economic dimension of the management of a company. So it's not used to reach to calculate the break-even point. That is more an industrial measure of efficiency for the companies, again, between costs and revenues. So between two economic measures of the performance of a firm. Here we are on the financial side. So the gross national income or net income, none of them, we are talking about cash flows. So we are talking about cash measures, okay? So usually if the cash flows are not uniform, we will not use this kind of method. So we will not use the payback period, but if we can see the example before, it's better. In innovation-based project, the break-even point is not important. I don't think so. I always think that the efficiency is important, but of course we have different inputs for the model. So we will have different inputs for estimating the costs and the revenues. So let's have a look at this example. Management at the Daily Green wants to install an espresso bar in its restaurant that costs 140,000 and has a 10-year life. It will generate annual net cash inflows of 35,000. Management requires a payback period of 5 years or less on all investment. What is the payback period for the espresso bar? So what is the rationale of this model? I have one initial outflow, that is the investment required, the numerator, okay? And then I have $35,000 per year. What is the payback period of this investment? So what is the time in which the investment will repay itself? I have to do, yes, please. It's 4 years because it's 140,000 divided by 35,000, perfect. So it's 4 years. This means that after 4 years, the initial investment will be totally repaid, okay? If our company, if this Daily Grind asks for 5 years or less for the investments to be repaid, this means that this project, this investment is acceptable for our firm, okay? Because its payback period is less than 5 years, okay? Yes, 4 years, perfect. So what is one of the main limitations of this kind of method? We have one initial investment and we have 10, in this case, inflows, okay, that this investment will generate. One of the main limitations of this model is that it does not consider the so-called time value of money. So it doesn't consider that €1, $1 today is preferable, is better and less risky than $1 tomorrow. And this because $1 today, €1 today is again certain. It doesn't suffer for inflation and it doesn't suffer for the risk that tomorrow I could not have the same dollar, okay? This is why this method that is called the payback method, the simple payback method, is not so useful to be adopted. And this is why, okay, this is the solution. Some alternative methods, okay, some alternative methods have been developed that are based again on the capital budgeting techniques. So according to these techniques, we consider the cash flows not in their simple manifestation. So we don't consider $35,000 or $140,000, but we consider the time value of the money and the risk of having a specific amount of money available in a time that is different from today. So if we move money in time and we put some money in the future, or if we have some money in the future and want to know their value today, we have to discount this cash flow. This means that we have to consider a measure of the time and of the risk of moving, let's say, this amount of money in time. The measure of this risk and time value of the money is the interest rate. So the interest rate at which we discount the cash flows is the measure again that includes the time value of the money, defined as the fact that the same amount of money has a different value according to its availability in the time. And this different value is also related to the risk of effectively having this amount of money. Okay. So of course, if $1 today is worth more than $1 a year from now, because again, we have the certainty of having that dollar today, a project that promised earlier returns is preferable to an alternative project that promise later returns. This is the way in which we can rank different projects and decide on which project to invest. Okay, let's see first to answer this question. So if you have these at the assessment and if you have to use calculation, let's see first how the next example works. So if you have no problems in solving this, that is of course very, very easy. You will probably have to solve this kind of exercises, very, very simple exercises at the assessment. And you will have the calculator on the platform, or you can bring your own calculator. But let's see first how it works. So what is the rationale at the base of the discounted cash flow method? Is that I have the availability of the cash flows generated by an investment in the future. So one project promises inflows in the future, okay? One project promises that it will give the company $10,000 per year for 5 years. Okay, so I have a time span in which the project will generate inflows. I have to define what is the value today. So I have to discount these cash flows and calculate what is the value today of these inflows. So I have to calculate their present value. And again, to calculate their present value, I will discount these cash flows with a specific rate. So let's see this example. IOC, so our company, has to buy a new computer. It can choose whether to pay 3,000 immediately or pay 300 euros immediately and 2,080 in a year. Knowing that the market interest rate is 11.5% each year, so this is the annual rate, what is the most convenient choice for the company? So let's suppose that we have to choose between two alternatives. From one side, we have a present value that is 3,000 euros, okay? From the other side, we have an alternative. We have 300 euros today and one negative inflows in the future with a discount rate of 11.5%. Okay. We should decide today what is better for our company. So we should put into comparison the two values, so the value of the two alternatives today. Can you solve this, or do you want to see it together?
2,800 541 plus 0.150 elevated at -1
Mhm.
divided for I don't know.
No, divided for nothing.
No, divided for no, that was the
Yes, it's elevated minus. So it's power minus, yes. Okay, so I have to, the rationale is for the present value that I have to define the present value of a sum that will be a negative cash flow in the future, okay? So I need to know how much, what is the value of this 2080 today, okay? Because today I have to choose. So from one side I have 3,000, for the other I have 300 plus the present value of 2080 discounted at this rate, 11.5%, okay? Why it is discounted?
Why did 2080 are discounted? So that in market interest rate is referred to.
Is the referred to the rate that is referred to the cost of the money, let's say.
Okay,
So
they are borrowing money.
no, it's referred to the actual to the interest rate at which I have to discount the sum. So it's the rate that we use to discount the cash flows. Okay. Okay, so actually it was quite easy. So we have $3,000 today and 300 plus 2,080 discounted, so divided 1.115, and this is the final result. So at today, the value today is between these two alternatives, paying 3,000 or paying 2,811.21. So the most convenient choice is paying 300 and 2,080 in 1 year. Actually, we are using this, we will come back to this. So we are using this formula, that is the discount rate. So we have, okay. I will write it on the slides. So we are using this formula. We are using the cash flows divided divided 1 plus R elevated T, that is the time. So actually, this is the general formula for calculating the present value. So we discount the cash flows at a specific rate that is, in this case, 11.5, and we elevate this 1 plus R, okay, that is the factor for discounting cash flows at the time. So considering that we just have 1 year, okay, because in the in the previous slide, we said that the payment of 2,800 was due in 1 year. This will be 2,800 divided 1.1115% elevated 1. Okay, so this is why we use this formulation. Okay. Okay, so actually this formula, and in general the formula for discounting the cash flows, is just useful for understand how we can, through the discount rate, calculate the value of a specific sum of money at its present value. So by dividing for this factor, so for 1 plus the discount rate, and putting the power at the time in which the amount of money will verify, we are able to again to discount these amounts of money. So this is the rationale that is beyond, okay, the actualization process or the discounting process of the different amounts of money. So we have in this case that a specific investment will generate expected cash flows for 4 years of $1,000 each year. And we have that the discount rate for this specific investment is 6%. So the present value of all these cash flows is based on the discounting process. I have again to define what is the present value of each of these expected cash flows at the time 0. So at the time in which I'm expected to do a specific investment. So here again, for the general formulation that we saw in the previous slide, I have that here, as I'm considering the first year, the discounting process will be X, that is the inflows, multiplied 1 divided 1.06, that is just a simple discount rate. Here I am in year 2, so of course this will be power 2. At year 3, I will have this factor power 3, so elevated to the 3rd year, and here I will have power 4, so elevated at the 4th year. In this case, I will have the present value of all these different expected inflows that are related to this investment. Okay. The sum of all these present values, so the sum of the present values of the different inflows, is the present value of the investment. So I know that the present value of this investment is $3,475.11. Okay. How can I calculate the net present value of this investment? The net present value is given by considering what is the initial investment, so the initial outflow that is related to this investment. So if, for example, the initial investment of this specific project was $3,000, I have a negative cash flow of $3,000 today and positive present values of all the inflows of 3,475. This means that the net present value, that is net present value of the expected inflows minus the initial outflow, is positive. And this is
The net present value is $465. It's not the total minus the initial investment.
the net present value of the investment, yes. So the net present value will be, yes, $475.11, yes. So the difference between the present value of all the expected inflows and the present value, because I am considering the initial investment here at time 0 of the outflow, so of the negative cash flow that is related to a specific investment. Perfect. So what is the criterion according to which I can apply the net present value for choosing between different investments? So usually if an investment has a net present value that is positive, okay, that specific investment will be eligible for being realized, because it means that, again, the present value of all the expected inflows is higher than the initial investment. So the first criterion is having the net present value positive. If I have to choose between different projects, and for these projects I have different net present values, I will choose, if of course the initial investment is the same and the length is the same and the discount rate is the same, okay, I will choose the project on those projects that have the highest net present value. So I have one general criterion for applying the net present value, that is, again, net present value positive. And between different projects, I will choose the one or the ones that have the highest net present values, considering, of course, the same initial investment, so the same sum at time 0, the same interest rate, of course, and the same length of the project, okay? Yes, perfect. When positive, I accept. If I have to choose between different projects, I will choose the higher or the higher projects. So what is the advantage of this method? Basically, the discounted cash flows considers, again, the time value of money and the risk, and these two measures are considered by the discount rate instead of the payback period that just considers the sum of money with no considering the time value of money. And also we have that we might have some formulation of the net present value that configure two specific ways in which we can apply the net present value. So we can have the present value of an annuity if we can derive from a specific investment the same amount in terms of inflows for a very, very long period of time. And in this case, we will call it an annuity. Of course, you don't have to learn the formula for calculating the annuity. If we have that these specific inflows will have their manifestation forever. So if this very, very long time period can be calculated as forever, we have the perpetuity present value. So we just have that we discount the cash flow at the rate. And in this case, for example, can be applied when we evaluate, for example, a company, and we have to estimate its value. We can apply this method by considering that specific inflows will verify forever, so for all the length of the life of a company. And we will have this formulation that is related to the perpetuity. So this is again the annuity if we have the same amount for a very long time, 10 years, 20 years. If we can state that the specific inflows will verify forever, and again, this is the case of company evaluation methods, usually, we have the perpetuity present value. So we estimate, we assume that the specific inflow will verify forever. So another way for applying the discounted methods, so the methods that are based on discounting the cash flows, is the discounted payback period. So to overcome the limits of the payback that does not consider the time value of the money, so doesn't include in its estimate the interest rate, the discount rate, we can consider the payback period. So this means that we can consider, instead of considering the simple cash flows, the discounted cash flows. So let's come back to the previous slide. We have this kind of investment, okay? So we have an initial amount of money that is an outflow and 4 expected inflows, okay? So to consider the payback period, we just considered these inflows, okay? So we just consider the simple value without discounting them, okay? It's what we applied before. If we apply the discounted payback period, we consider these as the sums for calculating the payback period. So we again overcome the limits of considering the inflows without discounting them. So for example, if we take the same example and we again consider this, so the discounted cash flows, and we're supposed to have an initial investment of 2,000, we cannot do the sum and dividing because we don't have the same cash flows. And when we have different cash flows, we can't just sum them up. We apply this method in another way. So we see in which year the sum of the discounted cash flow reaches the initial investment of 2,000. So we have that at the end of year 1, we will have $934. That is less than 2,000, okay? So we will sum the cash flow of year 1 with the cash flow of year 2, and we will have more than 2,000. Okay. So this means that between year 1 and year 2, the investment will be repaid. You didn't get the word discounted. Discounted means from the future to today. Yes. Otherwise, it's capitalization. If you move one sum today to the future, it's capitalization. The opposite is discounting.
Between year 2 and year 3.
No, because we have to accumulate. Sorry, I didn't see the most important thing. We have to accumulate the cash flow. So at the year, we just have 934. At the end of year 2, we will have 934 plus 1080. Okay.
Professor, is it a problem to explain it one more time, this example? I'm sorry.
Actually, it is, of course. We can say that as these cash flows are estimated at the end of each year, we can suppose that if, for example, we have, we can say that this investment will be repaid hopefully in the first month of year 2, because we here have 934 and here we have 1080. So probably in the first month of the second year, we will have this investment repaid, because 1,800 plus 900 is 2,700 and more. While with the simple payback period, we would have just said at the end of year 2, because we had $1,000 per year. Okay.
Discounted payback period is used when we have different inflows for the years.
Sorry, the discounted cash flows?
It's used when we have these different inflows in the.
No, it's for sure used when we have. Actually, it's preferred to the simple payback. So usually the payback period is not so much used. It was formulated years ago, but then we use this because even if we have the same inflows, so even if we have $1,000 for each year, the discounting process makes all the sum different. Okay, so sorry, not this one, but this one are different. Okay. Yes, okay, I will explain it again. Okay, the discounted payback period is the application of the payback period with the discounted cash flows. So this means that instead of considering the simple inflows, okay, I will consider the discounted inflows. So I will consider these ones. This means that I will not consider year 1, 1,000, 1,000, 1,000, and 1,000, but I will consider 943, 890, 839, etc. How is the discounted cash flow method applied? So if I suppose that the initial investment of this project is $2,000 and I have $1,000 for a year, in the simple formulation, it will be 2,000 divided 1,000, okay? So the payback period will be 2 years, okay, with the simple formula. The discounted payback period uses the cumulative sum of the discounted cash flows, of the discounted inflows. So I will have in year one, $943. In year two, I will have $943 plus 819. And it will be this one, 1,833. Then I will have at the end of the third year, 943 plus 890 plus 839. And I will have this one. At the end, I will have 943 plus 890 plus 839 plus 792. So the cumulative inflows. This means that while with the simple payback period, I have year two, so I might be sure that at the end of year two, I will have my investment repaid. It is not true, because I can see here that actually this repays in the third year. I believe I said that the second year. It's not true, because with the discounted cash flows, with the discounted inflows, I know that the sum of $1,000 discounted in today, so the value of this money today is not $1,000, it's less. So the more I go on with the years, the less will be the present value of a sum of money, of course. And so here I see that this investment will be repaid in year three, or between the last month of year two and the very first month of year three. So 1 year later than the result with the normal, let's say with the simple payback period method. So there is a discount again, because it's actually, these are two, as I was saying before, these are two of the main techniques that are used to give sense to the notion of the time value of money. So there is a discount because I have to consider a measure that includes time and risk. Time and risk in estimating the value of a sum of money in different times. So if I have this amount of money in the future and I want to know its present value, I have to discount this money. And I divide for the discount rate 1 plus the discount rate, or for the discount rate if I have a perpetuity. On the other side, if I have one amount of money available today and I want to know its value in the future, so I want to know $1,000 today, what is the value of $1,000 today in 5 years? It's a totally different process. So I will multiply this sum of money per this rate. So I will do money per 1 plus the rate and consider the time. So these are two mechanisms that are used to define the value of money according to their availability in the time. Okay, actually the important things to remember of these methods are: what is the payback period? So what is the rationale? What are the limits of the payback period, simple payback period? So not considering the time value of the money and the risk associated to different availabilities of money in different time periods. What is the discounted cash flow methods? What is the net present value of a project? So again, we call it net because it considers the initial amount of money. This is why it is net present value. What is the discounted payback period and what limitation it overcomes with respect to the formulation of the simple payback period model. So another quantitative techniques that is based again on the evaluation of the investment projects is the internal rate of return. So of course, we will not see how to calculate the internal rate of return because it is a topic of different kind of courses. But generally, the internal rate of return is the rate of return, so the amount of return, and it's expressed as a percentage. So it's expressed as a rate that describes the return of a specific investment project. So this is why it's called internal rate of return. So it's the, again, rate of return of a specific project. Usually the internal rate of return is the specific discount rate that applied and used in the formula of the net present value makes this net present value equal to 0. So it is the minimum rate of return that the project should guarantee to have at least the initial cash flows, so the outflows of a company, equal to the inflows. So this is the economic significance of the internal rate of return. So it's the rate that equals the initial investment to the discounted, and they are discounted at the internal rate of return, inflows. Why is this important? So usually it is important because the internal rate of return represents the minimum rate of return that is required by a company. So if a project is able to generate at least an internal rate of return of, let's make an example, 4%, that specific investment will be acceptable. And usually the internal rate of return is also compared with the discount rate. So usually if the internal rate of return is higher than the discount rate, the net present value will be positive and the project will be accepted. Vice versa, if we have the opposite conditions. However, especially those of you who already studied this internal rate of return should know that it's usually calculated through a process of trial and error. So usually, as in general, the calculation of the internal rate of return is a very, very difficult process because again, we have to find that specific rate that equals the net present value to 0. It's calculated through a trial and error process, and usually companies start from the discount rate to see what is the result, and then they adjust the estimation of the internal rate of return to find that specific rate that again equals the net present value to 0. And it is also it has also some limitations because when we have investment with a high variety in the cash flows, we might have the so-called phenomenon of multiple internal rate of return. So we might have that different rates equal the net present value to 0. So we might have, for example, different cash flows, also positive or negative, okay? That might generate this case. So we might have, again, different rates that equal the net present value to 0. This is why it's rarely applied, but it's very, very difficult to apply as a method. Yes, there is a cutoff. So as I said before, usually companies have some rate, some internal rate of return that they require. So the projects that meet that cutoff, that means, as the example that I was doing before, at least the 4% of internal rate of return. So project that meets this requirement in terms of internal rate of return will be accepted, others will be refused. So what are the positive and negative elements of these quantitative methods for evaluating projects, and especially of the methods that are based on the discounted cash flow methodology? So of course, they are based on mathematical formula, and so they provide concrete numbers and solutions. And also they explicitly consider the time value of the money and the risk. Okay, so with the fact of considering the discount rate, again, they consider the time value of money. So of course, what are Maria Giovanna, I will finish this and then I will reply to your question. So what are the weaknesses? They of course are based on estimation. So they are based on the estimation of the inflows, because while the initial amount, the initial investment is usually a certain amount, companies do estimation about the inflows. So of course, it's accurate. These methodologies are accurate if the estimations are accurate. Otherwise, they lose significance. And of course, as they are strictly quantitative, they could not consider the strategic relevance of the project. So they don't consider qualitative factors. They don't consider that, for example, if we have a specific set of time in which we want to evaluate our project, from that time on, that specific project could start producing value, or they don't consider the fact that, for example, even if a project is estimated as having a negative net present value, and we know that having a negative net present value means for a project to be eliminated, but even with a negative net present value, a project could have a strategic relevance. Okay, and maybe it could generate positive inflows later on, so after the time in which it has been evaluated. So of course, a mix between quantitative methods and qualitative methods is usually the way in which projects are evaluated. Yes, 0 is better than negative value. So of course they get accepted because a value, net present value of 0 means that a company is not losing money. So again, the general criterion is accepting project with a positive net present value. Yes. It might be accepted if, for example, it has strategic relevance. Okay, the last quantitative method that is used for choosing innovation project is the one based on the real options. So what is generally an option, especially in the financial markets? Do you know what is an option in the financial markets?
Between the investor and that is helping us to buy the stock. So, I mean, contacting them about what they will do with the stock.
Okay.
Depending on the value of the stock.
Other definition or improvement of this definition?
Just not code derived or secondary financial instrument.
Yeah, so an option is generally a contract made with an institutional investor in general, based on which a subject usually acquires a right, okay? So with the options contract, I'm not buying a stock, I'm buying the right of buying or of selling a stock that is usually a derivative, so an underlying stock or other kind of contract. So the rationale between the real options, the options in general, is of course is also related to the fact that money might have different values according to the time in which I consider this money available. Because with the real options I'm doing today, so I am signing today a contract with the right of buying tomorrow or at the end of a specific period. Again, a right of buying or of selling an underlying product at a specific price that I define today, okay? So the real options to the evaluation of the innovation projects actually applies this rationale, this logic, applies the stock option model specifically, so applies the call in general, the call option model to the investments in R&D. So of course they are, these kind of options are usually used in that industries or markets that are characterized by high uncertainty. This means that the value, the future value of the underlying resource or investment that is at the base of this option contract might have significant changes. So here again, we are starting from an environment in which we have high uncertainty, and usually the investments in R&D and in technological products, in technological innovation are this kind of investments. So let's see how this real option and especially the call options work. So again, an option contract gives today a person the right to buy, because it's a call option, a stock or an underlying product in the future at the price that is decided today. And this kind of price is defined the exercise price. To give you an example, today I am signing this call option based on which in 1 year I will buy at $1 each 10 stocks of a specific company. This means that $1 a year is the price at which I will buy the stocks, and the exercise price is this $1 a year that is defined today and applied in the future. So what happens at the end of the stated of the defined time? So what happens when I have to exercise my option? If at the end of this time period, the value of the stock is more than the exercise price, this means that the stock has a value that is higher than the price at which I decided to buy this stock. Of course, I will exercise this option because I'm buying that stock at a lower price with respect to the price that this stock has on the market. Okay. If the stock is worth more than the exercise price plus the price that I paid to exercise the option, of course, I will exercise the option. If the stock has a value that is lower, so if it's worth less than the exercise price, of course, I will not exercise the option and I will lose the money that I paid for signing the call option contract. So how we can apply this real option and especially again the call option contract to the R&D investments? So we suppose that the price of the call option, so the price of signing the contract, can be associated to the cost of the R&D program. So I am paying for supporting an R&D program. This program will, of course, need future investments. That is the cost for capitalizing the R&D program. So future costs. And this can be assimilated to the exercise price. So to the price that I will have to pay to capitalize this cost of the R&D. Of course, the returns of the investment are assimilated to the value of the stock at the end of the period. So again, I have here 3 kinds of elements. The price of the call option, that is the investment, the cost of the R&D program. Then I have the exercise price, that is represented by the future investment needed for capitalizing the R&D program. And then I have the returns that are related to the specific R&D program that can be assimilated to the value of the stock in the call option, general call option in the stock markets. These are some examples, okay? So let's suppose that the investment okay, is the license to commercialize a specific technology. So this is the R&D program. The option is the right to commercialize a specific technology. So again, the option is always a right of doing something at the end of a specific and stated time. The benefits, so the revenues related to that specific R&D program are, of course, the stream of cash flows related to commercialization, manufacturing, the experience, the marketing and distribution experience, of course, and the exercise price, so the amount of money that I will have to sustain to exercise my right of commercializing the technology are, of course, the cost of manufacturing, the cost of marketing, and the cost of distribution. Factors affecting the duration is, of course, in this case, the patent time limit and the availability of substitutes. So the factors that can affect the time at the end of which I can exercise my option. So here again, if we consider the equity stake in a partner as the investment that provides the option is the effective right, okay, to acquire a partner. The exercise price is the cost, the effective cost for the acquisition of the partner, and the returns are related to the cash flows and to the capabilities of the partners. So in this case, this kind of options can be used especially again in highly innovative and highly uncertain context, in which instead of directly investing in a specific R&D project, we can use the rationale of the call option in the stock market to invest in specific R&D programs. Of course, when this model has some limitations with respect to the original model developed in the stock market. First of all, let's start with the last one, that is the most significant difference with the stock market. The value of the stock option is independent of the call holder's behavior, usually in the stock market, while on the other side, in the R&D investment, it is shaped by the firm's capabilities, complementary assets, and strategies. So, of course, while in the stock option market, we usually have this kind of financial instruments that are used for exercising rights and also most of the times for speculating on the so-called derivatives. And of course, the call holders doesn't have an effect on the value of the stock usually. Here we have that the value of the stock, so this means also the revenues that will be generated by a specific R&D program, are directly related to the capabilities of the firm. Of course, in this case, participating into innovation process, it's not the same of participating in the stock option market, because we can also access the stock option market with small prices, usually, while on the other side, participating in the R&D programs of companies is usually not accessible at small prices. So, of course, this is also a main difference between the capital markets and the application of the call option model to the R&D investment programs. Okay, so the slide, yes.
At slide 14,
Outside?
Why the discount rate is 10%? I don't understand that.
Oh, it's an example. It's just an example. Okay.
Professor, I
It's
want to ask-
given. Okay. So just exactly here also, well, it was given, so there is no reason why this 6%.
It's not cumulative of the other discount rates.
Professor,
No, this one is the discount rate 6%, but it's totally it's totally given, so there is not a reason why it's okay.
Professor, I want to ask-
Okay.
Hello, Professor.
She cannot hear us. Try to type.
Okay, so we will see you. I will see you next Tuesday for the assessment, right? Okay. So see you on Tuesday.